I share my 46 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Well, folks, we're going to try another live stream. If this computer blows up, then I've going to have to go and reorganize everything that's running. So hopefully we'll get through tonight. Tonight I'm going to talk about the last couple weeks here that as we wind down 2025 and get ready for 26. Let's get into tonight's video. Okay, so we'll get into tonight. Hopefully some folks will show up. There's a couple people showing up. I didn't announce that I'm going to try to do Monday through Thursday, although this Thursday may be an issue. I'll let you know as we get through the week. So I first came in, I thought, what the heck hit the markets? We're up 46 handles on the S&P. It's the December rollover. So my favorite time of the year, not really. We go through the S&P, we'll take a look at some of the, we'll look at the December contract. It's still top of mind for me. I'm not ready for the rollover. So anyway, couple things that's continuing to happen. I kind of feel sorry for the Bitcoin people that don't understand what's going on in their world, screaming that Bitcoin's going to double, triple, go to $1 million isn't going to make it go up right now. And the reason why I started with this, it just seems ridiculous from my viewpoint that you want the U.S. government involved in Bitcoin. Somehow now that they have a reserve, I've seen people go, this is the most best recommendation and that there's ever been. I would think not. And as if you haven't read that article that I wrote, please go and read that. It was on price discovery. And this goes for all markets. And we're used to it in equities and, different types of commodities even. About 30% of the float actually is what controls the pricing mechanism or the price discovery. And I can tell you the hodlers have nothing. They're not doing anything. And I bring this up because if you look at risk on versus risk off, and you look at Bitcoin, it's on its own right now. Somebody's really pressing this thing hard, and no matter how many times $1 billion is being bought by some little tiny 3% holder, which is Mike Saylor, and it's not going to control the price. At what level does a 3% holder in any large equity, $2 trillion equity, does anyone care about? And the answer is they don't. And it's the same thing here. And I think there's going to be some challenges. I'll go through the analysis here shortly where the breakdown point's going to be. We may be able to survive here for a little bit longer around this 80,000 level, but there's going to be some challenges, and they're going to be substantial, and we'll see just how the hodlers are hodling, I guess is the best way to put it. So let's talk a little bit about equity markets as we wind down this year. Last night's, I talked about there's a clear shot to April. And this is based upon the database and what the forward-looking metrics are telling us what to do. And I'll go through that when we cover the database in a minute. But there's no reason for risk assets to go down substantially right now. You've got a little mixed bag at the top where, where NVIDIA sometimes under pressure, sometimes it's not. The Mag 7 are in play. Apple acts well. There's other symbols out there that act pretty well. The reality is the equity markets aren't likely to make any big moves right now. And one of the things that I talked about in last night's Kendall report is is that the database is really solid right now. And the forward looking is at least April to June, which is hard to believe, folks, because we're looking at back to back to back double digit returns. And no, and I talked about this before. I think it's possible that we get 5, maybe 6 years of double digit or positive years anyway. There may be some challenges, but I just don't see it coming. And last night, I'm going to see if I can find a couple charts that I discussed in last night's Substack. And let me just see if I can bring this up very quickly. And I think this is one of the things that, yeah, let me just go ahead and bring this up and we'll discuss this. Yeah, so I've got the unemployment level, right? So we're going to get these numbers tomorrow. And I don't think they're going to matter much. Might be down or up. I don't think that. But I want you to notice the slope of the curve. It's towards, I put this 5%. I think we're heading probably toward a 5% unemployment level. And that, so what you're going to hear is that the labor market is under pressure, and it is not. What's happening with the labor market, in my belief, is between right now, December of 2025, and coming into probably all the way into the second quarter of 27. I've been working on the outlook for 26, but looking that far out, we're going to see employment start to continue to rise a little bit, but it's not because the economy's not performing. The employment isn't equal to what the economy's doing. I get the jobs thing, but as far as economic output, they're not one of the same, especially up to 5%, which would have been looked at. I remember when 6% was a really good number. Like, okay, we're at 6.2. That's a good number. Not 4.2, 4.5, where we're pushing right now, but all the way at 6.2. But here's what I believe is going to happen when it comes to the employment numbers. The employment numbers are going to have to normalize with higher output from GDP output, higher productivity output. All these things are going to start to normalize over the next year and a half. And people are going, oh, see, AI is taking away jobs. It's going to be the way, this is an opinion, a way that jobs are distributed versus the overall outlook that jobs equal the economy. And this goes back to what I've talked about before, where the Federal Reserve system, what it's based on, and the dual mandate that Powell always spits out, which is not even a real mandate, in my opinion, but it's like, employment and price, normalized prices, you're not getting inflation. That's their dual mandate. He probably says it in every presentation he does, whether it's the big FOMC meeting or any of them. He probably says it at least 3 to 5 times every time. And the reality is that is the way they've been running, and I've been talking about this for a while, that this is the way that the economy has been run. This is the way that the Federal Reserve looks at the economy. And now what we're going to see is productivity, possibly initially with fewer people, but the redistribution that I'm talking about is where jobs are going to go. And that normalization is going to take anywhere minimum of 1.5 years to maybe even 3 years to get there. And so the economy and the output of the economy is going to be ultimately more important than how many jobs there are initially. And we're talking about a 1%. We're not talking about material like, the pandemic going to 10, 12% unemployment, or in the GFC and the great financial crisis, looking at 18, 20%. That's not what we're talking about here. We're talking about normalization, redistribution of where money in the economy goes and where the jobs go. And just to tie this together, we also have a massive amount of CapEx going to happen. So the CapEx is going to be another level that we're going to have to watch as well, because this is going to be, I've talked about this before, the infrastructure build out of the new economy. And it's not just AI, it's going to be all types of manufacturing. And the folks that are so focused on the AI bubble and all that, it's just another one of those noisy dialogues that people like Bloomberg and CNBC latch onto, and this is what they want you thinking about. And the narrative that is very seldom is it even right. And there's usually a great opportunity to fade most of these narratives that the financial press puts out. But this chart, I remember those of you who've been around the channel for a while or even reading this Substack for the last couple of years, if we go back to 2024, we were over 4.2 in employment. I remember saying, well, we're at least going 4.4. We're there now. Now it looks like that trend is continuing as we go down this trail. So we're probably going to see 5. I think what I see happening just from the normal metrics that I evaluate everything I do from as far as the economy or any stock is the 200 day moving average. This is day, but this should be month. This chart was, I didn't notice when I put this, but these are months that are going by down below on the scale. So you're looking at, probably 2030 when this thing finally normalizes, we start to see the economy start to go down. So we're looking really at 3 years plus out here. This is going to be the general trend. The TDS people out there will be telling you Trump's economy is terrible, but meanwhile, when you look at GDP and actual output, productivity, that's not going to be the real story. So you're going to have to be able to dissect some of the real story versus the story that you're being fed. And that's always my job. And, what I'm seeing right now is that's where we're heading as far as the narrative goes. They're pushing it pretty hard as far as the AI bubble, and it's just going to end all of a sudden. And I know all the circle income that's going in between all the AI companies and the chips and all those guys hanging out together. Well, that's the case in any industry that's blowing up like this is. You're going to need more of all of this stuff, energy, all of this stuff. So I'm getting close, I think, to coming up with a pretty good narrative for next year. I'm still working on a couple hypotheses that I'm challenging within my confines here, my little laboratory. So we'll see how this all plays out. But in the end, this is what you're going to hear. The realities is what you want to watch. So somebody once said, listen to the words and then watch the actions, right? So we're going to listen to the words, we're going to listen to the narrative, and they're going to keep probably feeding this false narrative that somehow the employment numbers are going to equal what the economy is going to do. And I think this is a very unique time. You could argue that that's always the case, Bob. I'm telling you that this time there's going to be a bit different narrative, and especially if I'm right and we start to see productivity pushing 5.5%, maybe as much as 8%, seeing GDP grow equal numbers, like crazy numbers. Now, I was around in 1986. Most of the stuff, some of you, I know I have a slightly older viewership on this channel, but most of the stuff that you folks think you've only read about, I've lived through. And I can tell you when in 86, I believe the GDP was pushing close to 6.5. You guys can fact check me. It was 85 or 86. But the reality is the average for the entire decade was 3.1. I think we see numbers that we've never seen before. maybe average for the next 10 years of 5 plus. And the reason for that is AI, it's robotics, it's having workers, we'll call them workers, robots, that work 24/7. They don't get tired. They don't get thirsty. They don't do all that. And I believe this is what Musk is shooting for. I believe that this is not only the robotics, but all the automation and the intelligence that's going to come. Will we get AGI? I don't know. I'm not predicting anything. What I am saying is things are going to continue. We're at the beginning of what's going on, not at the end of it, in my opinion. And I think, RoboCop. I've said this before, from my viewpoint as an older guy, I'm looking at, I don't have to be put in some assisted living care next to a bunch of smelly people. I can be in my home having a robot. My view of robots are for personal use. They'll be a lease deal every 3 years or 5 years. You get a new model. They just replace them. They recycle. There'll be literally millions of these things. So some parts will be recyclable, but that's how the world I see. And Musk is telling us that some of these robots will be better surgeons than the best human surgeon than you could find. So having, the kind of care at point blank, and I'm picturing for $300 to $500 a month. Right now, assisted living care, if you're lucky, you'll get it for $30,000 to $50,000, and then you'll have to post what these assisted living care people are doing right now are basically taking your children's inheritance just to take care of you in your last days. So things are going to change a lot here, folks. So I'm all in on the AI thing, and anybody that has not gotten into AI just hasn't taken the time or to find out what it's really about. Okay, so I think enough of my rant there. Let me come back on full screen. So all of this scenario and this narrative that I'm talking about is just beginning to unfold. And the next phase that you're going to start to see, and it probably won't be until maybe second or third quarter of 26, is when we really start to see some of these effects, some of this robotics start to come in, some probably manufacturing first, but I don't think we're far off. I think we're 1 or 2 years, at least I'm hoping that's the case, because I tell everybody, the day I can have an Optimus robot in this house, I will have one. And it'll just be such a game changer for personal care, not doing laundry and stuff, but being able to oversee, especially older folks that don't want to leave their home. Nobody wants to leave their home. Usually their kids end up shipping them off to some assisted living care situation just because everybody's living lives. Your kids don't have time to come over, stop their life to take care of you. So anyway, I'm done with that, but let's set up the rest of tonight. I'll try to get through this as fast as I can. But basically, I'm going to go through the database. Last night, if I made last night's Substack free, just have to subscribe to be a free subscriber. And the reason why I did that, because there were some metrics in there that I was talking about. Let me just... I'm just trying to find something here. Let me see if I can bring this up on screen real quick. So far so good with the stream. That's good. I've got things minimized. So let me bring this up. Let's go back over here for a second. So this is last night, but here's where, if you get this, I want to talk a little bit about what I did last night as far as the database goes. And as far as the intermediate database goes, I went through and tried to break down forward-looking expectation by sector. And it also, in this letter, will give you some feel for which sectors are likely to at least operate longer within the trends that they're doing, and then ultimately operate within the context of their returns by a sector basis. And if you have WaveTech, you can drill down into individual stocks and industry groups, all of that, and at least get the Substack. So kindlereport.substack.com is where you'll get that. And ultimately, probably should I'm working on a project right now to enhance the WaveTech software from two viewpoints. One is actual use in building your own personal portfolios, but also bringing in more intelligence, like what I wrote about last night in the Substack, which is just down below here. So basic materials is a mature cycle you would expect. You got, the metals and all of that stuff is getting, don't someone say Bob predicted a high in silver or gold or any of that. Not saying that. I'm saying that these materials, a lot of those stocks, the miners and things like that, have been working really well. Not saying they're going to stop here. I'm just saying they're more mature in the cycle than they are new in the cycle. They've actually, if you were just using WaveTech and the metals alone, I believe there's a pre-built strategy in there that has the metals in there. You would have been way ahead of this game. You'd been long the metals for a while. This is not a surprise if you're using some of the technology and the methodology that I use as far as managing portfolios. But this is worth, I'm just putting it on the screen for you here. This is worth the taking a read to get a feel for some of these sectors. And I believe I have all the sectors holding. So those of you that don't know and might be new around the channel, is what WaveTech does, it actually it has a map for every symbol, every sector, every industry group, what the typical holding period is, what the returns are. And it's been built, those models go all the way back to 1980. So they're looking at 45 years of data behind the rotation and things that happen. And this is why I always cover the database, because it's got so much insight into what's going on from that standpoint. So this is why I covered the database, but I kind of wanted to break down a little deeper into this. And this is also telling us about future rotation, all of those things. I remember I started off a year ago, roughly, and telling you that I thought we were going to get, by the time we got to the election, that we would be at the mature part. Well, we got a whole refresh and a whole nother cycle from the election a little bit over a year ago. But the original, if it went back to the beginning of 24, I was telling you probably got an upward cycle until around maybe July, and then it extended to September, and then here we are now. It's still extending. We had the whole first quarter thing based on a bunch of, once again, a narrative that you were fed that the tariffs were going to cause all kinds of inflation and Trump was rolling over, there's going to be a crash. And then we woke up on the 11th of April, finding out that was a low, and it was a 40+% moonshot straight up from there. No one actually talked about, they did, but it wasn't mainstream that we just experienced. They'll tell you that there's a 10%, we're in a correction. They'll tell you we're now in a bear market, we're down 20%. No one mentioned the bull market at 20 and then going to 40%. This is one of the biggest rallies that we've experienced, and maybe going back to '08 or even before. It was certainly more vertical and quicker. So there's been a lot of money available to be made if you were willing to pay attention to these cycles. So as as we go forward, these are going to be part of the narrative that's going to be in the background from an intermediate standpoint. And that will also be a lot of narrative that's going to drive what I'm thinking going forward. And I know already on my preliminary notes, looking at the outlook for 26, this is already a big piece of some of the building blocks that I'm building from the model I'm trying to put together and how next year potentially is going to rotate. You want to say, hey, Bob, by the way, we were up 52% compounded rate of return. Now we're up another 20 plus. So where does it end? And that's what I'm trying to tell you. This thing, I believe we had 6 or 7 years in the 80s that were basically vertical, right? And this is something very, very different. I know this is a big dialogue. I'm still kind of connected into my rant, is that the narrative is going to be that we're walking into an age that's never been seen before. The metrics that you're going to see, my opinion, is going to be much bigger than anything we've ever seen. If you go back to the 2024 outlook that I did last year and look at the narratives around all of the major booms that have happened in this country, period, and on the planet, no matter what industrial boom, whatever it was, if you go through those metrics, what's happening right now is already bigger, and it's going to get it even bigger. I think I can cut my rant. So let's do this. We'll come back and we'll do a database, and I'll try to fly through as fast as I can. I've already spent like 26 minutes on this, but it's just been on my mind all weekend, and I wanted to make sure that you folks got to hear this. And I'll come back and look at some of your comments. So please comment, hate it, like it, whatever you think, agree, disagree. They were some of my favorite comments to read through. So, all right, so let's go ahead. Let me just get over to some things we can work on here. All right, here we go. So this is WaveTech database. This is the daily, and I'll zoom in. We're back to almost 42% again. If you recall, we got down to about 18%, but the intermediate did not go lower. Let's flash over there for just a second. We come over to the intermediate. We're at 64.19. And what I want to do is come over here. We had basically a rotation for this last week on the intermediate. We had roughly 900 new buys, and we had about 1,200 sells. So we had a slight negative rotation down, but in the end, we're at 64.94. So if you recall, and I don't know if we're going to go through another one like this, but in 24, the intermediate would not drop below 61% bullish. And what we got was a rotation. This was a rotation. We had as many new buys basically as we did sells. So every stock that was long got replaced with a brand new trade. And what does that mean when this happens? It means that we basically rotated the database. And if we come over here, for those of you that have the WaveTech software, right here you can see optimal daily is 39 on a short term, where only current average duration is 6 days. So what happens is when you replace data like what we did yesterday or on a weekly, let me come over here. So on optimized weekly, we're 68 days. The average is 206, and this was the metrics that I worked off of last night in the Substack newsletter. So we're literally 33% through the cycle. We don't get to 100%. We will get into higher 68, 72, 78. None of these metrics ever get to 100. I've never seen them get to 100. I've seen, get into a 95% bullish, but even then, as far as the duration of the trades, it's not possible to get there because of the way things are cycling different. But 68 to 78% range is very common to get to an extended duration or down to a 10 or 12% duration on a downside, looking for basically a rotation, a switch of direction. As it stands right now, we are solidly, as I said in last night, that we're in this April cycle that is telling us that we're going to at least to April to June. And if we get a further rotation, we could refresh this database to even extend beyond that. What happened in 24 that I was just referencing is we saw that 61%, but we started to see big tranches of rotation, which kept the duration as a overall environment into keeping it positive, and therefore keeping the markets relatively positive as well, even though we went through, like right now, I would call us that we've been in a sideways correctional phase since September. We bounced up on basis the S&P and the futures. We've been hitting up around 69, right at the 69, just a little bit over 69, then we get a reaction out of there. It's interesting, we're down 28 handles now on the near contract. I'll show you in a minute, but we're seeing a lot of selling come into the futures on probably because of the rollover and all that. But these metrics that we're looking at right now, let me go back to the daily. We go back to the daily, and we'll bring in the rotation for today. And today we had more selling than we did. We had a slight negative day, so we had basically 880 sells versus 200, we'll call it 300 new entries. So we had a negative rotation on the daily. Let me come back over here and go to the daily models. So like I said, we're at 41.94, so we're pushing right at that 42%. So we're off just a little bit. We get above 42, then we get another positive rotation. So let me come, as we take a look at what's happening here on the daily, we're still have this positive rotation. So we've got what I said we're going to talk about, and I'll do that right now, is what we're looking at is that there's still 65+% bullish on the intermediate. We're climbing back towards this 42 handle on the daily. So this just tells us we're going to have more positive income, more positive rotation and movement to the upside, at least keeping that underlying bias in the markets, both on intermediate and daily. Could we get a little correction? Sure. Anything's possible, but a material correction where you're going to see these metrics completely deteriorate in the next couple of weeks doesn't appear to be that likely. Although they're selling really hard right now. It's pretty amazing. Now we're down 35 handles. Just because I'm talking like this, they're putting that out there. All right, so let's go ahead. Let's go ahead and take a look here. This is the December contract that I've got here. Let me just. So this is December. You can see it's coming down. This was a level that I've been talking about, is down to this 40, this 21, 40 period moving averages. There is some downward bias, but we're not going to go down to this 200. We do have just this sideways movement. And like I was saying just a minute ago, we come all the way back here. This is October. So October to current, we basically have been trading in this range. It's possible to retest 6,500 level. I don't see that in the current environment, but there's that. Okay, let's go ahead and take a look at the weekly real quick. And I'm going to go through this part. We're sitting right on the 10-week moving average. And this is the December contract. Okay, so now let's do this. What happens, and this, I hate the rollover times when you're doing continuous contracts. The rollover, it looks a lot different. So for instance, like right now you can see we're down 49 handles on TradingView right now on the December contract. So let's do this. And so now when we go and roll over to the March contract, now we're still up 11. We were up 46, so we've dropped 40 handles off of that. This is kind of interesting that I bring this up after just making the statement I did. We do have downward projections to come down to this pivot, which is, I've got a weekly chart up here, but it looks like the 21 week. So let me change something here. All right, this will be a little better on us. I've accidentally switched over to the weekly chart. So here we're trading right into this 40. We're going to stay within this, and we're going to go back to the weekly now that I brought that up. But the configuration, even if we look here on the Augos, everything is really locked in, and you can see the projection. These dots are the indicators, the WaveTech indicators. If you want to check those out, it's kendallreport.com/indicators 2024 or 24, and you can check out those. They're on sale right now. I believe TradingView still has a big deep discount as well, but this here, what I want you to see is the red dots are flatlined. All of the moving averages are projecting flat lines, so everything is going to stay fairly tight. Probably the best trade out there is probably doing some straddles and collecting premium on these indexes right now. That's probably the best out there. So let's see if I can get through there. Where am I? 37 minutes. Okay. I try to keep to an hour on these things, on these videos. Now, we've definitely been seeing more volatility on the NASDAQ. We're seeing a little bit of unwind in some of the tech stuff that's out there. But even then, we're seeing the PPM3 is projecting down. Not a big decline, but it is projecting that we're going to see some decline. But it looks to me, let me just bring this up so we can draw in this section here. So we've got, you can see this downward slope. So we have a downward slope in this 10. We're getting these crossovers right now. And you're looking at someone that has been focused on moving averages since 1983, maybe 82. And it's been a main focus of my analysis. But when you start to see an area like this, where you get an area where all of the moving averages are crisscrossing, that's a trendless environment. Tells you that we're probably going to trade sideways. And especially when the longer term averages are, some are up, some are down. Whenever you get that, that just means we're going to stay in some kind of consolidation range. And typically what I use, since the market grid is also part of the indicators, these dots are showing you different support levels and resistance levels for each bar. So what we're looking at right now is that let me just get some colors here. So yeah, so this market grid is probably going to set up some kind of formation where it starts to contract, and it's going to contract around these moving averages that are right here. And so that's typically where the market's going to stabilize here. Makes sense if we just look like at bigger patterns, you know, we get kind of a zigzag formation. Let me make that a little thicker. Yeah, so this is what I'm talking about here, where we get this type of formation. You probably get maybe an ABC, maybe an X wave that comes up, and then another ABC, and then all of a sudden, you know, you're out in, this is February right here. So this type of configuration we're in is probably going to be this, because you have to ask yourself, what's going to happen in the next 2 months that's going to be earth-shaking and different? Probably not. It's probably going to be a while that we stay in this kind of configuration mess that we're in right now. Just call it a mess just because we're getting all these zigzag type formations. I'm going to go to weekly. We'll use the NASDAQ here. And I remember talking about this last month, and this is where we're going to end up. All right. So if we come back to this formation here, we're getting this set up here. So this 21 period moving average probably going to be the bottom end of that range. Looks like it's 20. I'm not sure it's right. I'll double check it in a minute, but 24,610. And you see the market grid starting to collapse around it. So we still have this upward bias coming into March, but it's not like this vertical. It looks like maybe, at least for what this forecast is telling us right here, is that forecasting out into May looks like there's some possibilities there. As we get closer to that, there'll be some fine tuning. We'll have more input. We'll have fundamental input. We'll have everything we need. But for right now, it looks like we're sideways, slightly biased to the upside. That's what I'll tie everything together. That's what the database is telling us is going on as well. That's that upward bias. Doesn't mean we can't trade lower or trade in within a larger pattern. Then that's the case. So let's do one more thing. We'll use the metrics here as well. Let's go out to a monthly. And this will bring everything in, and we're not even going to worry about having the PPMs up here right now. But you can see the angle of attack of, I'm going to do something. Hang on. I just wanted to, I switched over to the S&P cash since I'm doing this presentation. What I want you to see, there wasn't enough data to calculate the algos off of the monthly, but this is S&P cash. You can see we have upward bias all the way into May, but it's more likely going to form into a larger sideways pattern. Probably punch up some new highs. There'll still be that positive underlying tone. That's going to be the case. If you recall, if we go back to when I was talking earlier, what we were looking at is that the April period is the first time the database I was discussing will actually give you the point where you have a possibility of a potential stalling point from the database maturity standpoint. We'll see how it all works when it gets there. But right now, everything's biased to the upside, downside limited. We should be able to chop. So what that means from if you're a stock trader, what that means is you can now, you want the buy the dip trade is on, and it will be on. You're just going to have to bring up whatever stock you're trading. Know that the indexes, maybe you'll be under pressure a little bit more, and then you want to buy against the similar metrics on the stocks. And once you do that, you can do that with, let me just bring this up here. You can see that the upward bias is going to stay in place. Here we are, once again, March. So coming into March, April is going to be the first real challenge from a trend standpoint that we're going to have. Doesn't mean that stocks and things can't move around a lot and volatility increase, but it does. That's the first point coming into, let's just call it coming into March. Early April is where things are going. So when I put on last night's Substack that, April is the first clear sailing, here we go, right here. It says clear sailing through April, okay? And that's the other thing, actually, it triggers me into a good spot here, is the capacity of utilization is going to probably get higher than we've seen it. I've seen it in the 82 handle, maybe 84. But we could see some really crazy numbers come out of this productivity that's happening here. All right, so where am I at? I know I'm getting longer too, 15 minutes. So let's go ahead and let's bring up, I have not done this for a while. Let's get over here to a weekly, let's do a weekly Russell. So Russell's managed to finally, if you look at where the S&P and NASDAQ went to, we're still lagging substantially. And, the Fed did lower the rates. I think they do another 50 basis points. I think they do it before April. Now, for some people, maybe the dialogue ends up that, that unemployment number keeps going up. I was telling, this is where in my opinion, will be misinterpreted for what it really means. If you didn't hear me say that, spin back on the replay of this video and you can listen to that. But the point is that the Russell still, I'm arguing, is not going to make any big giant moves till the yield curve has at least a 75 to 100 basis point differential between, we'll say, the 1-year bill and the Fed funds to the 10. And the 2 10s are not a good indicator. Everybody banked a whole lot of money on the 2 10s equaling recession that never happened. I told you it was never going to happen because that was the wrong metric. I call that the retail metric, the 210. That's the amateur metric. You really want to see more of overnight money and the really bare bones money, because that's where the bank is making money. Banks are making the big money off that very front end overnight funds and what they can finance under a year. And that's where they're going to really leverage a lot of the money. All of this index, a good portion of it, is regional banks and small community banks. There's all kinds of little banks and people that play on that spread differential. Until that spread differential gets further than where it is right now, which right now it's almost, we'll give it 25 basis points off of the very, very front end of the curve. Don't look at the 2 10s. That's the noise. That's what they're feeding you to, I guess, to sell you some of these stocks. But anyway, so that, but it's positioned much better now than it has been than the previous period. So what I mean by that, we go back to the last time we made highs in November of 24. this is a much different relative position than there was before. I think we can build a much better base to build from. Here was clearly, and those of you who've been around know I was screaming about this. This was a distribution top. This was absolute bull trap if there's ever been one. And this is, not only did it come off that high, but it even went below the 200 period moving average. This time, I don't believe we have that same metric in play that we did before, because if you come over here, if you can see down where my cursor is down below here, during that time, the 200 was declining. We finally got a turnaround in June of this year showing that the 200 is starting to turn up. That's telling you the longer term trends are just now making a turn. And they started making it back in July. It's been a good trade off of this from July, but the big trade will be the next phase that it, once we maybe come back into the 40 or pull back into this pattern a little bit, that will happen, and that will be the trade only if the Fed funds and 1 year less treasuries are at least 75 basis points lower than what the 10-year is. The 10-year does not have to come down. In fact, I don't think it will. I still am arguing that 375 is the max, and probably 450 is probably the top. So max meaning that's the maximum rally on the bonds, and the men would be somewhere around 440, 450. I don't think we get much below that. All right, how am I doing on time? Got 8 minutes. Let's do gold. Man, I'm going to do gold and touch on silver. So here's gold on a weekly basis. It was interesting because we're finally, early January, we might be able to get some move down, but this, I want you just to look at this. Look at what the gold trends are telling us. It just all up. I mean, we're talking 27. This is weekly. Out here is late 26 all the way into 20. This is October 26 up here. So the trends are still showing that they're going to go up. The only thing that's happening is we are in what I call trend maintenance mode. So those of you that have the PPMs lesson for the PPM for the indicator users is this. All right, I'll go ahead and use this. So this indicator, all of these indicators, even on the 200, this is what I call the trend maintenance mode. So they come down here, you get up, and then they go flat. So you basically get this peak and then a flat. And they're not about divergences and things of that sort. It's interesting that this is a 200-week moving average is steady up, and you can see all of the averages are along this upward trend. This is the angle of attack. So it's so here this is just telling us that this is all the way out into late 26. So there'll be corrections, and the miners for the first time are starting to roll out. And I can't give you the values, but it's probably 4,700 out here. 4,600 plus on gold out at this level. And these are weekly trends. So once we get in these trend modes, well, you're buying the dip, but you're buying against the 10-week moving average, simple, don't get fancy, simple average, or the bargain will be the 21. So if you get as low as the 21, those are bargain periods to add, especially if you're adding to long-term positions. Let's do a quick silver, and then we'll hit Bitcoin. So silver's got a bit different configuration. Let me just go with this chart. Still very vertical. They don't even show that it's rounding off until like $70, $72. The red dots are showing us that we're going to curve into this 10-period moving average, but it's the same scenario I just said on gold. You want to be buying the dips on against that 10-period moving average. And right now, that number is going to be like $61. Wherever it goes, it could go to 78, pulls back to 61 as long as these metrics are in play. Let me show you. This is all the way into, this is January 26. Yeah, we're looking even, this another PPM lesson. Even though you're seeing this decline, looks like the market's, this is signaling a rollover. It is not. What it's signaling is a test of this 10-week moving average. And you can see at the lowest value, if you look off to the right, it shows 0.61. Anything over 0.25 is a trend. And that means you can buy against that 10-period moving average all day long, almost fearlessly. Okay? All right, let's do Bitcoin. So we'll start with the weekly here. I'm going to give you a number that I've 83,800. If you're a Bitcoiner and you see something under 83,800, you're probably going to at least to 69, we'll call it 70,000. And there is, if you get to that level, there is probably a 60% probability you'll see 58,000. You'll see this 200-week moving average value somewhere near it. What the algos are telling us, even when we come, let's see here. I'm just trying to see where the turn happens. Yeah, around February, the 10-week moving average will finally be able to be challenged. But this pattern we're in right now is the critical pattern. And, you know, I think it's sort of kind of funny that the amount of rhetoric, if you go on Twitter, I mean, can you find anything other than a post telling you about how Bitcoin's going to go vertical and it's going to be all-time new highs in like 6 weeks, and Tom Lee telling you the whole move happens in 10 days. Boy, he, you know, I don't know that. He doesn't know that. Nobody knows that. But what I'm telling you right now are the probabilities off work that I've done for 40 years. I started, these PPMs first came in 1984 is when we developed those. And the angle of attack came in around 84 to 80s. 85 is when we came up with the whole angle of attack. We were working on the probabilities on when a moving average was going to be a valid trend line and when it wasn't. Right now, the trend lines are all above the market. You can go to the 200. I don't know what kind of data. Oh, this is what I want to say before I lose the thought, is if you listen to people, they're telling you about this 4-year cycle. You're talking about a 4-year cycle of something that's been around 16, 18 years. That's not, there's no validity in that because something's happened 4 times. That's how it's going to work from this point. Who comes up with these ideas? It's just amazing to me. And who comes up with the ideas? The people that have a stake. So anybody's telling you Bitcoin's going up right now is Michael Saylor or, you know, Mr. Lee or somebody like that who has their entire lives at stake in this thing. And I was telling a friend earlier today that imagine not only a 3% holder, that somehow Michael Saylor is like the king. He bought $1 billion. I mean, so what? It's a couple $1 trillion market, you know, and yeah, he's got a bunch of this, but it's all under debt, right? So he's convincing everybody to do his preferred stock, and I'll say the word, people will criticize me, but Ponzi scheme does come into play just because he's getting other people's money to buy more, and it just stinks. You know, I think one of the risk of Bitcoin is what I said in the article that I wrote. Let me just see something here. I think I can. I'm just trying to see if I can bring something up. So this article right here, I'll bring it up for you folks, I hope. So this is the article I would like folks to read. A special report, will Bitcoin evolve into what it feared, which is a mainstream asset? And it's already done that, by the way. But but read this article. It's free. It's pinned to the top of my Substack right now. Read this thing because it's going to explain what's going on when I'm going through this. Right now, the entire price discovery is being determined by 30% of the float of Bitcoin. But it's the same thing with NVIDIA, with every stock that's out there. If you're a reasonable analyst, stock analyst, the very first thing you're going to do is to see what the float is, how much of the float is, what is the turnover of the float. So those are the people that matter. Those are the people that are setting the price for Bitcoin. If you're hodling, you're not part of the price discovery. You have nothing. But if you're ETF, you're a market maker, you're a futures market maker or trader, all of those folks are guiding. And a lot of this stuff is synthetic Bitcoin. So, you know, it's just not like I've been saying for a while. The folks that have absolutely they've compromised the entire Bitcoin ecosystem because of who they've let in the party. So I've said that enough, but read that. Go to kindlereport.substack.com, sign up, get the free version. Right at the top there's pinned, and I do at least two free versions of the newsletter every week. So, you know, get signed up there and consider being part of the community. Also, in the next 2 weeks, I'll have the annual, the 26 Outlook out as well. All right, I think I am finally done. So let me go and yeah. Why is everything dropping? The old saying, more sellers than buyers, and I need to do a video on this. I'm not going to go through it right now, but what drives price is not how much volume, it's the actions of the volume. And I'm going to do a video on that. I've talked about it for years on this channel. It needs to be just a video on price discovery, on trading, on reading order books, which is when I'm trading, I use the order book. Like 85% of the input of when I'm buying or selling is because of the order book. So I need to just get that out there. Let me just see what you folks have been on your mind here. So bear with me while I look through some of your questions. Yeah, thank you. Those dings are sign-ups for the newsletter, so I appreciate that. Somebody was asking about the Optimus. Yeah, will they need plumbers, welders, construction workers? Yes, I believe they will. Even though instead of having, you'll have like, it's just like anything with AI, right? Like I'm able to do programming because I worked on 3 software development groups over my years. So I know a lot of language. I know some of the things to look at. So I'm a reasonable AI programmer using Claude Code or something like that, I'm way better than I ever imagined I would be. In fact, I never imagined I would be. But I'm able to do things that you're probably not able to do just because I know some of the falls and how to pitfalls and how to find issues when you're programming, because I know some of the error types that come out of certain type of syntax errors, those type of things. So that's helpful, right? I've helped debug programs, and they're programs that I've owned and built. So on the plumber, so I get to the plumber, you're still going to need that overseeing, that human eye, and that like almost like the supervisor type. And then the robots will be doing most of the work, and they'll even have a lot of the input. But just kind of, I think originally it would be oversight, and we will need those. But here's the other issue: we can't find anybody who wants to do that stuff. None of the Zoomers, the 27 to 17, none of those folks, for the most part, want to be plumbers. They don't want to be those people, even though those jobs pay really good jobs, and you can make pretty good money. I still think there'll be that interaction with things. Yeah, So let me just look at a couple more things. That's my thoughts on that stuff. I don't know any more than anyone else, but you asked my opinion, so. Yeah, I'm just looking at a couple things here, folks. Yeah, let me see something here, see if I can. Bear with me. I'm going to look at something to answer a question if I have it on this account. I do not. That's a shame. One more. Oh, sorry. I thought I would be able to find something. Let me look at a couple more questions. Why is everything dropping? Yeah, I mean, it's just, it's year-end, profit-taking, all that. I don't know if the gold not dropping was just for tonight. I mean, gold's on as a perpetual machine of some sort right now. Yeah, so my main concern, David, main concern are how loud the dogs are barking. Dogs barking aren't a problem, it's when they bite, right? Yeah, it's an interesting scenario. I don't think Venezuela, if looking at the Caribbean, what's going on right now, whether they are wanting to do anything. Thank you. Let me look. Let's do two more questions here. Yeah. So unwinding the rollover was not talked about, and what can happen. I don't foresee it'll be anything different than any other time. That might have been what you're seeing a little bit of with this sell-off that we had a little bit ago. Not sure. I'll keep that in mind. Yeah, carry trade again. I don't think that's going to be a big deal. Once again, I'll kind of close down here. As far as the Japan carry trade goes, does anyone not know they're probably going to raise rates? I can't imagine it's a thing. There might be a spike out of it. I have not studied it enough to have a really clear opinion on that, but I think that it's probably whenever something's really noisy, that's usually not where the action comes from, right? It's not usually, you know, X is going to happen, so watch out for that. That would make it too easy. I guess it's possible. Yeah, and I just caught this. Randolph says the Bitcoin propaganda is biblical. That is an understatement. What that tells you, by the way, is how afraid the players in that space are. They are freaking out, especially the big players. You know, who think about this. You're a big trader and you're going to go, hey, I bought $1 billion. I'm buying. I've told you that, folks, before, back in the old floor trading days, we had what I called the promoters. They would be out promoting their position, trying to get more people to come on board. That's the whole Bitcoin trade, is we got to get more people, adoption. They think adoption is going to make them money, and it's comical to watch. I was talking to an old buddy of mine, matter of fact, one of my first partners, when we built the first software platform back in '94. Hard to believe, but we were talking earlier. I said, I've never seen anything where not doing anything is going to make you rich. Like, unfortunately, I hope it doesn't end in disaster, because it's going to wipe the entire segment of the population of millennials will be wiped big time from this. And, you know, if I was talking to somebody a couple weeks ago, and the migration between the 1% earners and holders of assets is huge. I mean, it's like a roller coaster. And people come in and out of that 1% space, no matter where you are on the planet. And I think this, you know, this could move, this could set people back a long time. I just hope it happens now versus later, because the later it goes, the bigger the fall and the less possibility of recovering from an event like that becomes further and further apart. So from that standpoint, I hope, if it's going to happen, what we're watching right now is the collapse, and get it over quick. Like I said, you can buy all the Bitcoin you want when Mike Saylor is out of business. Him and Tommy, those guys go down. That's when you want to buy, because I think they're being gunned for. I think markets. I always say one of my favorite lines is the markets always go in a direction that they can hurt the most people, and that can only be Bitcoin down right now. So I'm going to look at something real quick. Yeah, so we're at 85,892, 83,800. Watch that number. That will set the retest of the 80,000 print. And then I think 69 is next. And if that doesn't hold, it's 58 plus on the downside. I'm not saying that's going to happen. If those triggers happen, there's not going to be anybody wanting to hang around. That's when you get the full capitulation. And at that phase, you know, I think Saylor's average cost is it's going up right now, because he's paying 85,000, was 74, so 74,000. So he might be pushing 76, 77. He's raising his average price right now, and he's betting on that it doesn't go down below that. So best of luck. All right, folks. Hey, listen, thanks for watching. I ended up going 14 minutes over. Appreciate the engagement that we had today. Hopefully I did not get to the Meg 7 question, but I'll be around tomorrow, so maybe we can get there tomorrow. So anyway, folks, thanks again. Thanks for watching. Make sure you subscribe, like the video. Also get the indicator so when we get our new education going on Discord, that you'll be able to get involved with that. So it is kendallreport.com/indicators 2024 or 24. Either one, I believe, works. Anyway, folks, have a great evening. We'll see you tomorrow.